Hello, I'm Bernard Hickey from interest.co.nz and welcome to an economic weather report. Today we look at the latest GDP figures, which confirm we are in a recession. GDP fell 0.2% in the June quarter after a 0.3% fall in the March quarter. Now, together that's 2 consecutive quarters of negative growth, which satisfies the definition of a recession. This is the first recession we've had in 10 years. The last time, 1998, was just after the Asian crisis and a drought. This time, we've got the credit crunch, another financial crisis, and a drought. Interesting that the key things dragging on growth this time are housing, with the housing bubble bursting, exports because of the drought, and we're seeing a drag on growth from lower consumer spending. But on the other side, supporting the economy, we have high government spending. Manufacturing actually surprisingly improved, and we saw infrastructure spending, which is also helping to keep the economy going along. And that meant that the 0.2% fall in the June quarter was a little bit better than expected. Economists had expected a 0.5% fall. So government spending and infrastructure spending is buffering some of that economic turmoil. What we're going to see though in the December quarter, according to some economists, is a rebound in growth because the tax cuts kick in just under a week's time. We're seeing rebounding consumer and business confidence, in part because of the fall in the oil price. The drought has obviously ended. There was an awful lot of rain over the winter. High dairy commodity prices are also a factor as well. But it's only going to be a slight rebound, and that's what the economists are saying. I actually think we're in for a slightly longer recession than that. It could well last into 2009. Why is that? Well, the credit crunch is really getting worse. Credit rationing is on in earnest by all of the banks. Sovereign, the big broker run by ASB, which provides funding for brokers, that has stopped high loan-to-value ratio lending for property investors and has put on a lot of other restrictions as well. GE Money, one of the biggest providers of lenders into the broker market, has stopped lending out beyond 1 year. So we're seeing a drying up of credit going into the housing sector at least. We're also seeing banks being cautious elsewhere for just about everything except rural lending. And we're seeing some developments really starting to collapse in a heap very quickly. Just in the last couple of days, we've seen Cove, north of Auckland, and Kensington Park in North Auckland. Both of those projects have collapsed. Combined, they're worth about $700 million. And we're seeing globally a deleveraging, so that's debt being withdrawn from the property sector. And in New Zealand, 97% of our net wealth is tied up in property, so we really feel it when we think our house prices are falling. Now we expect, and we're a bit more pessimistic than most, we expect house prices to fall 30% from their peak in last November. We've already gone about 10%, so we still think there's quite a bit to go, particularly through the end of this year. That will depress consumer spending and also residential construction. And we think too that the dairy boom may well have bust. Dairy prices are down 20% in New Zealand dollar terms in the last 2 months, and just in the last week they're down 9%. There's also a real risk of financial market disruptions affecting our economy, given we borrow so much from the rest of the world. We also have high household debt. That is going to mean we are going to save more. That means spending less, and that will keep a lid on that rebound in GDP. We've also got to remember too, we don't expect a meltdown because, in part, we have very low unemployment. The last time we went into a recession in 1998, unemployment was at 6% and it climbed to 8%. This time we're going into a recession with unemployment at 3.9%. And the last really big recession New Zealand had, which was in 1991, 1992, I remember it well, I couldn't find a job. Unemployment then was almost 11%. And also, at that stage, wealth wasn't growing. And that's what we're going to see this time. Wealth is not going to grow. And just to give you a final reminder of some structural problems in our economy, so it's not just cyclical, this is a chart showing productivity growth over the last 8 years or so. It shows that productivity fell again in the June quarter and is negative and has been for most of the last 4 years. and has been falling for the last 8 years. We have some structural problems which mean that the rebound won't be as strong as many expect. I'm Bernard Hickey for interest.co.nz. That was an economic weather report.